Hi everybody, this is Sarah Close with Keller Williams Advisors Realty. We're going to talk a little bit today about the numbers that drive the U.S. housing market. And these are macro numbers, so not as dialed into a city or a neighborhood, but rather the macro trends that impact the broader base of what we're seeing in the housing market itself. So we'll talk a little bit about kind of where we landed at the end of last year. We ended up at about 4.1 million homes, and that was about on track to where we were the year before. What we're expecting in 2026 is to see that number increase slightly to about 4.3 million. And what we've noticed already in the beginning of 2026, except for the crazy winter weather that we had there for a couple of weeks, we had seen on a national level an increase in both loan applications, which would showcase that we'd be having a stronger spring market, as well as properties that had gone sale pending. So what they do actually is the analysts look at each individual week of the year and they compare that to the same week in the previous year to determine whether or not we're seeing an increase in the number of properties that are going under contract, or actually if we would be seeing a decrease. So both of those factors at this point are very favorable. Now, what we saw for January is that if we looked at the actual sales that took place in January when annualized and adjusted for seasonality, that would indicate that this year was going to end up a little bit below 4 million. However, we are expecting to see that increase, as I said, to a number that is closer to 4.3. When we look at where we are in terms of home prices in general, we are going to end 2025 with a market price of $414,000. Now, what we know is that in general, house prices increase about 3.9% per year. So what this tells us about being at $414,000 is that if we look at the long-term trend, and this is from 1990 to today, we would be approximately 7.4% above that trend line. So we have had several years of massive appreciation, and that's been making up for the gap in those really constrictive years that we had, call that 2007, 2008, 2009, etc. And then we saw this massive appreciation over the last several years. We're seeing that appreciation rate start to slow, but we are still above where we would be on the trend line. But as opposed to last year, that delta has shrunk significantly to now we're only 7.4% above that trend line. So what this tells us from a home buyer's or seller's perspective is that if I am a seller, I am not likely to see prices increase significantly, nor am I likely to see them decrease significantly because I'm starting to come closer to the trend line. And that's the same message that we receive as a home buyer. And that is that, quite frankly, the idea of waiting until prices come down is probably not going to yield a significantly more improved home purchase price because we just aren't that far off from where we are before. And especially if we look at this in individual markets, we still have some markets in our country that are increasing at a very rapid rate, while we have others that their rate of increase has cooled. I'm located in Southern Ohio, and we have still continued to see prices elevate year over year, but again, just not as quickly as they had before. So we're seeing a little more normalcy there. We are expecting actually for 26 to see an annual appreciation nationwide of about 2%. So if we extrapolate that, that's going to take us at the end of 26 just a little bit still closer to that, where that trend line would put us. Another big data point that is very meaningful as it relates to what to expect as far as home prices is to look at how much inventory that we have available at any one time. We speak in terms of a balanced market as being a market where in an area that's defined as a marketplace, if it were to take approximately 6 months for all of the homes that were available to be sold, we would consider that to be a balanced market where neither the seller nor the buyer has, from a negotiating standpoint necessarily, an upper hand. We were at a low monthly inventory rate in 2021 of 2.2 months of inventory nationwide. And as you can recall, those were the times when Properties were hitting the market, going in multiple offers, oftentimes going above ask price. And we ended up at the end of 25 at nearly double the amount of inventory at 4.2 months of inventory. Now, technically, we are still in what we would consider to be a seller's market, but we are moving more towards that area of balance. Of course, when you're in the market and you're a buyer, it doesn't necessarily feel like a buyer's market, or if you're in the market and you're a seller, it doesn't necessarily feel like a seller's market. But in terms of like kind of a relative amount of pressure on the amount of houses that are available for sale, we would technically say that we're still in that kind of a marketplace. We are expecting interest rates in 26 to come down ever so slightly. We averaged out in 2025 an interest rate at 6.6%, and our long-term trend line for interest rates, remember, is 7.72. So while there's a lot of discussion about the cost of money being very high, if we kind of periscope out and look at that in terms of historical trends, we're actually a bit below what that trend line has been if we look at those data points from 1972 forward. And we're expecting to see some very slight, albeit meaningful, changes in interest rates this year, and we're expecting that average rate to be about 5.9%. And what's interesting about that is every time we see an interest rate change of 1%, what that does for a home buyer is it actually increases their purchasing power by a full 10% of what they were buying. So in other words, it costs them the same amount of money to buy a home for $550,000 than it would for $500,000 when we're looking at the portion of that home that's actually financed. So it does make a significant difference as far as adding potential buyers to the marketplace because everybody can afford just a little bit more. Another data point that's very interesting is considering the proportion of houses that have rates at different levels. When interest rates declined significantly several years ago, many of us took advantage to not only buy houses, but to also refinance the ones that we already owned. But we've seen enough inventory come into the marketplace now with new home ownership that actually 48.5% of all properties have a mortgage interest rate that is 4% or higher. So what that tells us overall is that there will be many more individuals where the decision to sell will be a lot easier because they will not just be giving up their home, but they will also be giving up that really low rate. More and more of our active inventory has a mortgage interest rate that is a little bit closer to the market than it has been in previous years. We also know that overall, we have 21.2% of our market has an interest rate that is 6% or higher, and we have 10.2% of our market that has an interest rate between 5 and 6%. So that's taking an awful lot of our available housing inventory into a place where, should it be sold, we're not going to see that extra tax of giving up that ultra low interest rate. Affordability is another area that we really focus on when we're determining what the health is overall of the real estate market. Right now, we are operating, at the end of 2025 anyway, we were operating at about a 32% affordability rate. And essentially what that means, 32% of their income would be required to purchase the median price property. Historically speaking, that is not significantly above the long-term trend line of 27%. Comparatively, in 2023, the affordability rate was 34%. That felt really, really stiff because in 2020, we had an affordability rate of 18%. But where we are now is we're moving back towards, again, that long-term trend line of 27% because we ended the year right at 32. Another factor that often comes into play when we're thinking about the ability to purchase property, of course, is the unemployment rate. We ended 25 at a 4.2% unemployment rate, which is not terribly unusual or frightening for policymakers. We always have, at any one time, there is a baseline rate of unemployment. 4.2% is a number that is not going to require policymakers to jumpstart into a policy decision. But what is very interesting is that for the first time in quite a long time, the number of jobs that are sought in the marketplace is exceeding the number of jobs that are available. So that convergence point is something that we're going to need to be keeping an eye on, because if those continue to separate in the gap, that will obviously be indicative of an employment issue that could change into policy decisions that would affect housing, the cost of housing, and of course, an individual's ability to purchase. Inflation is another area where we dedicate a lot of our attention, especially over the last several years where we've had exacerbated inflation rates. What we're projecting for 2026, though, is an inflation rate of about 2%, which is very close to the target that government policy seeks to sustain. So we don't expect to see any policy decisions made around controlling the inflation rate. Now, what could affect that, of course, is where we are right now. This is being, the first part of March. We obviously have some geopolitical occurrences taking place that could affect inflation. We also have had some change in our tariff policy, as in our country anyway, that could ultimately affect inflation. But right now, what we are expecting to see target-wise is something a little bit closer to the long-term target rate of 2%. A softer metric that we also keep track of is consumer sentiment, and specifically how consumers feel about whether or not now is a good time to buy a home. And what is really almost shocking when you consider the significance of this number is that only 17% of all of those polled, when asked that question, believe that now was a good time to buy a house. To give you some perspective on that, in 2013, a full 79% of folks said it was a good time to buy a house. In 1998, 84% of those asked said now is a good time to buy a house. So that is certainly a sentiment that would weigh very significantly on whether or not an individual chooses to get into the housing market. Overall, when we look at what we are projecting for 26, there are the factors that we know now, and then there are other factors that we anticipate could potentially change our projection for where we expect prices to go and how many units that we expect to actually sell. And some of those that are in play, of course, are the policy volatility that we've all been experiencing as of late. We mentioned also that there might be a potential for a weakening labor market, which could certainly play into that. We are also seeing a little bit of correction in the AI world. There have been several opportunities for large data centers to be built. They're now actually being repurposed for other uses. As that machine is getting going, it's difficult to say where that large driver of the sector might ultimately end up financially. And then, of course, we have the combination of those and how they may affect inflation. And finally, as we suggested before, some of the geopolitical events that are taking place and what those conflicts might result in for us. As with any year, as we embark on the year, there's going to be a broad range of factors that could very much change the trajectory of where we think things are going to be. But that is no different than any other time in history. There will always be unknowns, but what we know is this, is that housing is the key foundation to wealth building for the United States. And for the median income earners, nearly 50% of all of their wealth is tied up in their homes. So getting into the housing market is something that is still highly advisable, regardless of what the political and economic conditions would be. Because a house is always going to be a good investment when you are not under pressure to sell it in unfavorable conditions. As an agent, the one thing that we have noticed in the last several years is that the rate of business has changed significantly. And if you're feeling that, I'm here to share with you that the metrics do back that up. In 2025, we actually saw sides per agent drop to 5.4 sides on average. So if you take the total number of licensed realtors and the total number of units and you divide them together, you're going to find that that is what that average number came out to be for last year. What is meaningful about that is that it is contrasted against the long-term average of 9 units per agent. So that is a significant change. So if you felt that in your business last year, it's because it was real. It was a major difference as far as what we saw units per agent. What was actually, though, very encouraging is because we have seen an increase in overall real estate values, is that the volume per agent actually went up, and that went up to just a little bit over $3 million per agent. From a seller's point of view, when we price our property to get it listed onto the market, we are obviously pricing it with the goal of pricing it right the first time so that we can achieve that highest possible dollar value with our buyer opportunity. But that being said, we still do see a significant number of price decreases. Nationwide, on average, 33% of all listings will have a price decrease. For the month of December, at the end of 05, or end of 25 rather, we saw 22% of all of the listings did have a price decrease. So it is something to plan for in your strategy when pricing your home to assure that you are either pricing it at that level where you know you can achieve a buyer, or you are mentally prepared to make that change in the case a buyer is not showing up under the time frame within which you want to sell.